Today I'm primarily going to focus on two macroeconomists, two macro market strategists, Jeremy Grantham and David Hunter, both extremely credible. I'll explain each one as I introduce those pieces. Hi, I'm Ben Reppond. Today is July 16, 2024. Welcome to my broadcast. I'm going to begin with an interview that Jay Martin, broadcasting from Vancouver, is doing with David Hunter. David Hunter has been around Wall Street for about 50 years. He's a strategist. He makes predictions. He has a track record, you can look him up, he has a track record of being extremely correct. I guess correct, you don't have to say extremely. And done a very good job, very highly credible. And Jay Martin is asking him some very good questions. He gives a view, I just want to give you the time frame here, that's very important because there's a good side, a positive side, and a negative side. So the time frames matter. So the positive side I will play first of what's going on, and that is for, in his opinion, for a period of time taking us into 2025. Since I'm broadcasting here in July of 2024, this could be 6 months to a year or more. And he is seeing that the market is going to go higher, probably quite a bit higher from here. So we are in kind of the blow-off phase, the final phase, the euphoric phase of the market. And it will tend to, it's already doing it, tend to draw in people who are not invested, or if they are invested, they will become invested even more. And that's what the last phase of the market does. In this macro view, he is looking at the current market, which is a bull market. It is both a bull secular market and a bull cyclical market. Secular markets tend to go for long periods of time, sometimes a decade or more. In this case, he says 42 years, which means from 1982 to 2024. Inside of that are some cyclical bear markets and bull markets. We could look at 1987, 2000, 2008. I don't know if you want to include 2020 and 2022, but if you do, those would be cyclical markets. Shorter term markets, they could be painful, but they're shorter than the long-term secular market. So we're in a 42-year secular market, and we are in what he calls the last phase of this market, which is building to become a super bubble. I'll get to Jeremy Grantham later, who talks a lot about super bubbles. But in this phase, so he believes this phase of the long-term secular bull market, and which includes a shorter-term cyclical bull market, will end next year. When it does, he will give the consequences of that and the response by the Fed to that. I won't try to summarize what he said because he does a good job of it. From there, the Fed is going to be printing money like crazy, and we will head into the last part of this decade up to 2029, 2030, 2031, somewhere in that range, let's just say 6-7 years from now. That's when everything collapses. And he gives the case for that. Now, there are people who have a hard time with that when everything collapses. Matter of fact, what he's talking about next year, that collapse alone is going to be significant. There are people who don't want to hear that. They are probably buy and hold investors. They have ridden the market down, they've ridden it up, they accept those kinds of risk. That could include bonds or not include bonds. But when you talk about a real total collapse of the system that he does talk about in 2030, 2031-ish range. It's not very pretty, and people don't want to hear it, including me. But you'll get to see his analysis. And then from there, I'm going to play a piece by Jeremy Grantham. And of course, if you follow Jeremy Grantham, you know that he is a student of super bubbles. Now, he looks at the 1929 to 32, and then 1979 to 82. And then he also looks at the 2000 and looks at that more from about an 8-year cycle, and calls that third one the third super bubble, and that we're now heading into the final one. Whereas David Hunter really says there's two, which is this one, which he pushes from 1982 to present, and then the one back in the 30s. So, but I think these two set the stage for what we are facing. Now, I say all of this to, number one, not to be a fearmonger, not to frighten you, but to educate you. And I also want to emphasize that both men are macro strategists. So if they miss something by a quarter or by a year or something like that, year and a half, that is entirely possible when you look at things from a macro point of view. So if you back away and look at this and say, okay, this is the view that they have. You can agree or disagree, but this is the view that they have from a macro point of view. If they are correct, this or something like it is likely to happen in this time range. May not be specific, because of all the printed money, everything is acting different than it used to act. So when they make predictions, we've got trillions sloshing around in the system still. So anyway, I think you'll enjoy it. And then, again, it's not good news. He'll give you the good news first, but we have to think about, I have to think about, and you have to think about, what are we going to do about it? How do we respond in a way that we don't get wiped out? And because a lot of people in this scenario are going to get wiped out. And there are some strategies that we can use that will prevent that or minimize that. So I'm going to begin with Jay Martin's interview with David Hunter. Take a listen.
But let's start just with your macro thesis, because you've been quite consistent since the first time you were on my show, probably 18, 24 months ago. And, this is essentially a melt up before the big crash, the end of the 42-year secular bull markets in equities. Any surprises since the last time? I mean, maybe the last month, right? Things going as expected for you? Any surprises? Any reason to change your thesis at this point?
I don't think so. If anything, I think things are coming my way. The trader type investor gets nervous every time this thing pauses, and you've got to go through those consolidations to build the wall worry and allow for fuel to build up the fuel for further advances. So I don't see anything out of the ordinary in terms of any pauses we've seen. Certainly we had that pause back in March, April that had a lot of people turn much more negative. And then we've gone on to new highs, and we've had a short pause here. I wouldn't be surprised, given what we're seeing in the NASDAQ and the tech side, and particularly semiconductors. I wouldn't be surprised if we've got a little bit more to go here. Might be 3 or 4% in the NASDAQ, and maybe 1 to 3% in the S&P and the Dow, and maybe even less than that in the Russell. I think the Russell's looking like it's almost done with its consolidation, and it's certainly lagged the market. So I'm expecting, once we get through June, the summer to be a strong summer for the markets. And I still have a 7,000 target. I changed my target back in January from a 6,000 to 7,000 range, and just dropped the bottom of the range and said we're going to 7,000. And I've said, I think if anything, I'm too conservative.
So now you've heard the optimistic side, the positive side of where the market is going from here. And again, I think a lot of people get pulled into the market with this. Now, Jay Martin is questioning him about the macro view. What do you see long term? What's going to go on? And this is what he's addressing in this next piece. So it's going to be a little bit longer, but it's full of information, and which is based on his analysis. So this will take us into the early 2030s, and we will get to the point where, in that point, way out there, there won't be any more printing of money. Interest rates will be 15 to 20%, and inflation will be in the 25% range. I won't call that hyperinflation, but from where we've been, probably something like that. And how does that happen? It happens because the Fed's response to what's going to happen in 2025, or this period he's talking about, is going to be printing and printing and printing. So we've gone from less than $1 trillion to this last period where we went to over $9 trillion. So now he believes that we will go to 20 trillion or above. What won't happen immediately is inflation, but it will happen. So, and then they're out of tricks. There is nothing left. And that's where interest rates get to 15 to 20%, inflation to 25%, or something thereabouts. And he says at that point, basically the music stops. And this will be very, very painful for many. And it will involve not just the market, but it will involve the world markets, because the Fed and our government are not the only ones who have been playing this game. Markets around the world, both developed and undeveloped markets, have been playing the game as well. So this piece goes through the second part of that. So take a listen, and I think you'll find it instructive. And then after this, I'll play Jeremy Grantham.
In your words there, when you zoom out though, David, and look at a global, take a global perspective and think about just the cycle of empire and where we might be in this present day American world order relative to the British world order and the Dutch world order and the Spanish of the past. It's really easy to make a case that we're in the late innings, right? You can just sort of paint that picture with relative ease. I don't buy into it so much, to be honest with you, because I think it's a pretty big question and a tough one to answer. But when you look at I guess the financial instability inside the United States, the internal conflicts, the external competitors rising up and trying to find optionality outside of the U.S. dollar. What's your take on the grander cycle of empire?
Yeah, I'll take it from two different directions, or two different angles. One is I believe we are in the late stages of a super cycle, and I define a super cycle as that period between that long cycle between two depressions. And so, from an economic standpoint, and politics kind of goes along with it, or society goes along with it. Basically, we've been at this cycle since the Great Depression, or since after the Great Depression, and I think the next depression is the 2030s. As much as I'm calling for a global bust next year, which I think is something maybe more dramatic than 2008-9, I still don't believe it's a depression. I think it's fairly fast, like 2008-9. So I think the real collapse comes in the 2030s. So you're basically in the last decade of a super cycle. And I think government-wise or politically, I think we're seeing it kind of parallels that. And then you look at the reason you get to the end of a super cycle is the excesses. And we've built debt up both in the U.S. and throughout the world to levels that are not sustainable. And what has kept me consistent in my view is that the equation that you come up with does not balance. You can't, I can see the seeds are sown. I can see the things that are leading to a period of time where we've got this massive debt that we cannot play the game anymore. In other words, you have the bust, and I say the stock market could go down 80% in the bust, but the bust is actually the economic and the financial system. goes down hard. You get, some major bank failures around the world, similar to 2008, 9, except this time I think it goes deeper and steeper. Um, in that bust, the easiest prediction I can make is what the central banks are going to do. They will come out with all guns firing because they have no choice. They either don't do that and watch the system implode now, meaning next year maybe, or they do that and postpone the inevitable for another cycle. And if given the choice between saving the system or watching it and saying, "Oh, we don't want to cause more inflation. We don't want to do that again," that's not in their nature. I mean, if they are looking at an imploding system, they're going to come in with all guns firing, and that means printing money like never before. So I've been on record saying I believe we'll see something like 20 trillion in new QE out of the Fed, and proportionally similar around the world. Every central bank printing like crazy. That saves the system here. They'll do all the fiscal things they have to do to go along with that. Save the banking system, save the financial system, and with a lag, turn the economy back up, and you'll have another cycle. The problem is we're so close to this inflation breakout we've had. You might get a year or two reprieve because I think that bust could cause short-term deflation. But within a year or two, you'll be right back into what we're in 2022, inflation moving up and moving up a lot faster and steeper. So that by the end of the decade, you're looking at, I say maybe even 25% inflation in this country, and interest rates, between 15 and 20% or higher. Short-term rates maybe even higher than that. There's no equation where the government can service their debt when you have that cost of servicing. So it brings the cycle to an end very quickly, whether that end is 2029 or 2031. It's somewhere in that period, I think, where the music stops, the game's over, the Ponzi scheme that's been in place for decades comes to an end. I mean, nobody's going to want our debt, and I'm just looking from the U.S. standpoint, but it's not just the U.S. It's Canada. It's around the world. Nobody's going to want to buy debt. You're not going to be able to do QE. You're not going to be able to monetize the debt because nobody's going to want it, and you're not going to be able to print money to monetize the debt because more money when you're in a hyperinflationary environment just turns into Weimar Republic very quickly. So, so in other words, you lose the printing press. The printing press is the only thing that's really allowed us to keep this going for the last 30 years. Without a printing press, our standard of living was declining. Without the government expansion we've had this last 30 years and monetizing that debt that financed that government spending, it would have been a reality long ago that we were in the later stages of our, this great experiment we've had, democracy or republic or, America. But we've been able to kick the can down the road many cycles because, you had feast and then you'd have famine, and it would cleanse the system enough that they could print money again and do it again. You're coming to the end of that. I mean, all of a sudden the cycles get much shorter. The inflation comes back much faster. The amount of money it takes to save the system becomes so much bigger. And that just leads to even more excesses. All of a sudden, you just reach the point where you can't do it anymore, even if you wanted to. So I'm pretty sure we're in that, whether it's, as I say, the difference between myself and a lot of the Austrians out there that, the Peter Schiffs of the world that want to say we're coming to an end now, is that because I think inflation is going to be, we'll either have almost zero inflation or deflation next year. That gives them almost infinite ability to print money. It gives them one more kick the can down the road moment. But after that, I think you've lost that, ability, and then it comes to an end. So the parallel to that is what happens government-wise, militarily, etc. I can't predict it, but I think it goes in parallel. The odds are, by the 2030s, world wars or world war is probably an inevitability, or pretty close to it. At the very least, I think we get a collapse of the the financial system we've known for all these decades. So it's, what comes out of the ashes of that, the vacuum of that, is it going to be totalitarianism or is it going to be a fresh start? I don't know. But to get there is going to be a very tough ride. I say, and I obviously have no way of knowing, this is seat of the pants, but I can imagine a period in the 2030s, and I don't know whether it's 2032 or 2035 or when, but a period in there where the collapse happens. We've got, in this country, no Social Security or very limited Social Security, no Medicare, no Medicaid, no welfare benefits, no unemployment benefits, and a 50% unemployment rate at least. That's dire. People are assuming always that the system will bail them out. If we get into trouble, there's always, the government to bail us. If you don't have a government or they don't have the funds, that's gone. So you have no support system, and then it's everybody for themselves, and that's not going to be a pretty picture.
Okay, now I've played Jeremy Grantham a couple of times in the past, and he is in his 80s. He is the founder or co-founder of Grantham, Mayo, and Van Otterloo in Boston. They manage about $60 billion worldwide, and they have offices in major cities around the world. And he's been at it since he got out of college. He is very accomplished. He's called the markets correctly, macro markets correctly in the past. Therefore, he has a lot of credibility, and because he's been around a long time. So he talks about the super bubbles and that we are heading into one and what this is going to look like. So I'll let you listen to Jeremy Grantham.
I only specialize in what I call the really great bubbles. If you go back to 1929 to 2000, to Japan and the housing part of the housing bubble, and you ask, how did conditions look? Profit margins looked great. The forecast was great. There was no chance of a recession. A few months ago, smart people were saying there was a 20% chance of a recession in 3 years. It is quite amazing. And what happens after the bubbles break is there's always a recession pretty quickly. People never get it. People never forecast it. And along with the recession comes a drop in profit margins. Going into the bubbles breaking, profit margins are always at a peak. Bubbles don't peak for no reason. They peak because economic conditions are nearly perfect. And that includes low inflation and high profit margin. And the first thing to go in a recession, of course, is the profit margin. That is very likely to happen this time. We should be in a recession, mild or severe is the question, but we should be in some sort of recession fairly quickly, and profit margins from a real peak have a long way that they can decline. The beauty about indexing is you never miss an Amazon or an Apple. And the bad thing about indexing is you never miss having a lot of overpriced stocks into one of the relatively rare bubbles, such as we have now. So it's kind of good news, bad news. If you can ride out the odd 50% decline, totally unnecessary, of course, on fundamentals 30 years ago. The market is mildly hysterical from time to time, and it's totally unjustified by the steady stream of dividends and earnings. But it happens. And if you want to ride those 50% drops, good luck. It works out very well in the long, long run. But it can take you 20 years to get back in the game. If you get caught in 1929, it works out just fine, but you don't get your money back until 1955. If you get hammered in 74, you don't get your money back until 87. And then when you've gotten it back for a month or two, you give it up again. And the same in 2000. By 2010, you're still losing money. So you have to be willing to ride out. And some people feel their lives aren't long enough to take the 10, 15, 20-year wipeout. So for those who feel they're brave enough and willing to try, I've always thought that sidestepping some of the pain might be a good idea. I think they're perfectly straightforward. They're intellectually easy and psychologically disastrously difficult. They're easy because in most cases, they're so extreme. It's like, how do you notice the Himalayas when you're standing in northern India? I mean, they come out of the plane and they soar up. You can't miss these things. 1928, 29 was just such a massive rally. So the sheer price rise, you can't miss. Secondly, just to make it easier, the great bubbles have always tended to rise faster and faster towards the end. And that's a kind of defining feature also. And then thirdly, they have all been accompanied by massive, public, obvious, crazy behavior. where the headlines migrate from the financial page to the front page, where they migrate to the opening few sentences of the evening news on the radio or the television. And they talk about market new highs, and they talk about what the Bitcoins of the era have done. I know it's not a stock, but it's a speculative instrument, and the GameStops of the world. And back in 2000, most of you will be old enough to remember the pet.coms and the utter craziness of that period. And the same was true of 1929. The same was true of Japan. We had a group from Salomon Brothers, a leading American brokerage house of the era, who came around in 88, 89, when Japan was moving to 60 times earnings, and explained that their yields, et cetera, and their interest rates, et cetera, they really should have been selling at 100 times, and they were cheap, and you should buy them. And it didn't stop the Japanese market breaking the following year. It has not recovered the high of 31 years ago yet. So that was pretty painful. Taught us, in a sense, a powerful lesson about how human behavior works. But it also explained to us why the big firms couldn't play that game. It is simply not a commercial proposition to get out of a bull market, because every now and then they run further and faster than you expected. Japan went on and on and on, way beyond people's expectations. 2000 beat the record. There's a lot of difference between 35 times earnings and 21, the previous record. So sometimes they break out to an astonishing degree.
Okay, hopefully I haven't scared you too much, or Jeremy Grantham and David Hunter haven't scared you too much. Next, I want to play a final piece from, it's only about a minute, from Anastasia Amoroso, and she is a chief investment officer of iCapital and strategist. And she talks about the market, more of a short-term view than the two gentlemen. The economy is slowing down, and the short-term view, in her opinion, is somewhat negative. Now, I don't know if this is a few months or what, but it actually kind of contradicts what David Hunter said. So he's seeing that the market is just going to go gangbusters until 2025 sometime. So I think I'm not sure which one is correct. I tend to agree with David Hunter, but I wanted to play this piece because it gives you an alternative point of view.
The S&P and the Nasdaq hitting new highs yet again as investors wait for key inflation data later this week. Joining us now, Anastasia Amoroso, the iCapital Chief Investment Strategist. Anastasia, great to have you with us. It sounds like you think we're setting up for some sort of a disappointment, that there's just a disconnect in terms of earning expectations and where we are at record highs.
I do. I think there's some ingredients that are definitely coming together for some market pullback and consolidation. And the reason I say that, I think there's this disconnect that is building right now between the economy that is clearly slowing and earnings expectations that are quite lofty. And so if you look at the economy, for example, whether you look at the Citi Surprise Index or the Bloomberg Surprise Index, that is now deeply in negative territory and has been trending lower for the last number of months. And the Atlanta Fed is about 1.7%, 1.5%, I should say, down from 4% that it was in the beginning of the quarter or second quarter. So I think there's a slowing momentum to the economy, and yet you compare and contrast that to the earnings expectations, and they've done nothing but move higher. And for this quarter, the second quarter in particular, they moved lower just a touch, much less than they typically do, which is 3 or 4% downward revision. So that's why, you look at this setup and you also look at this, what I call extreme market comfort with this Goldilocks scenario. Volatility is low, everybody's in the trade, and that's what's giving me a little bit of discomfort here. Okay, well, your portfolio is well diversified. Toxic, illegal, and risky. Doesn't sound very promising. So hopefully, if you have a financial advisor, hopefully yours is better than that. Okay, thank you for watching. If you have questions or comments, leave them in the comments section below. I will leave the entire clip for the David Hunter interview and the Jeremy Grantham piece there. So if you want to watch those in their entirety, they are there. And if you also want to check them out, if you don't know who they are, you can type in Jeremy Grantham or David Hunter in the YouTube search bar, and you will get plenty of material. It might be helpful if you want to investigate that further. Thank you for watching.